Daniel puts every extra dollar toward eliminating his debt. Ethan, on the other hand, has the exact same financial situation, but he takes a completely different approach. He only pays the minimum on his debt and invests every extra dollar into the stock market. One of them is following the traditional debt-first philosophy. The other is following what the internet calls the mathematically optimal strategy. Both are convinced the other is making a mistake. But when you actually run the numbers over 5, 10, even 20 years, the outcome is not what most people expect. And interestingly, the debt-first approach might be more accurate, not for the reason most people think. Let's break it down. Daniel and Ethan are both 28 years old. They each earn $55,000 per year, and they both carry identical debt: $22,000 in student loans at 5.5%, $14,000 in a car loan at 7%, and $6,000 in credit card debt at 22%. That's $42,000 total. After covering rent, food, insurance, and minimum payments, both are left with exactly $600 per month. Same starting line, same income, same debt. The only difference is how they use that $600. Daniel goes all in on eliminating debt. Every dollar of his surplus is directed aggressively toward it. He starts with the smallest balance, builds momentum, and rolls payments forward, one debt at a time. Ethan takes a different route. He sticks to minimum payments and invests his entire $600 into a low-cost index fund, expecting an average return of around 10% annually. On paper, Ethan's logic sounds strong. Why rush to pay off debt costing 5 to 7% when you could potentially earn more in the market? But real life rarely follows spreadsheets perfectly. In the first 2 years, Ethan looks like the winner. His investments grow steadily, reaching over $16,000 thanks to compounding. Meanwhile, his debt decreases slowly through minimum payments. Daniel's life looks very different. He cuts unnecessary expenses, sacrifices comfort, and channels everything into his debt. Within months, he eliminates the credit card balance, then attacks the car loan. After 2 years, here's where they stand. Ethan, around $16,000 invested, around $34,000 remaining debt, net worth minus $18,000. Daniel, $0 invested, around $19,000 remaining debt, net worth minus $19,000. Ethan is slightly ahead and doing it with far less stress. But this is where the story changes. Ethan continues investing $600 monthly while carrying high-interest debt. His credit card alone costs him over $100 in interest every month, guaranteed. That's money leaving his pocket no matter how the market performs. After taxes, his actual return drops closer to 7 to 8%. Meanwhile, his blended debt interest sits near the same range and much higher on the credit card. That small advantage starts to disappear. Daniel, however, is moving toward a finish line. By month 34, he becomes completely debt-free. No payments, no interest, no obligations. Suddenly, his financial situation transforms. He now has not just $600, but around $1,400 per month available to invest, combining his surplus and freed-up payments. He quickly builds an emergency fund and then begins investing aggressively. Meanwhile, Ethan is still juggling debt. His investments are growing, but so are his financial obligations. His progress is slower because part of his money is constantly being drained by interest. Fast forward 10 years.
Daniel invests heavily for about 6 to 7 years. Ethan invests consistently for all 10 years, yet Daniel ends up ahead. Why? 2 reasons. First, Daniel paid significantly less in total interest, saving thousands that could be invested instead of lost. Second, once debt-free, his monthly investment amount was much higher. Larger contributions compound faster even with a shorter time horizon. But there's something even more important that numbers don't show: behavior. Ethan's strategy only works if he is perfectly consistent for an entire decade. That means investing every month, ignoring market crashes, never withdrawing early, and never reacting emotionally. In reality, very few people can do that. Studies show that while markets may return around 10% annually, the average investor earns far less, closer to 3%, because of poor timing and emotional decisions. Daniel's strategy avoids that risk entirely. During his first 3 years, he isn't exposed to market volatility. He can't panic sell what he doesn't own. Every dollar he puts toward debt creates guaranteed progress. His plan is simple and, more importantly, reliable. That's the hidden advantage. This isn't just about math, it's about behavior. If your employer offers a retirement match, you should absolutely take it. That's free money and an exception worth capturing. And if your debt is very low interest, investing can make sense. But once interest rates climb higher, especially above 7 or 8%, the balance shifts. The real question is this: are you truly going to invest consistently for the next 10 years without hesitation? Not just in theory, but in reality. Because the best financial plan isn't the one that looks perfect on paper, it's the one you'll actually stick to. Daniel and Ethan started in the same place, with the same income, the same debt, and the same opportunity. But Daniel built momentum, eliminated risk, and gained control. Ethan relied on optimization, but faced constant pressure and uncertainty. And in the end, discipline, not math, made the difference. So the next time someone tells you paying off debt early is a mistake, ask yourself one simple question: would you really invest that money consistently, or would it quietly disappear? Because that answer determines everything. If this changed how you think about money, hit like, subscribe, and share it with someone who needs to see this. Smart decisions compound, just like money.